One of the biggest positive factors when buying real estate is all the tax benefits you're able to realize. Real estate is actually one of the most tax-friendly investment vehicles. You can write off practically everything: mortgage payments, expenses, even the property itself in most cases. Of course, there's multiple ways of structuring a real estate sale as well to defer tax payments. First, let's start with the three most common ones that apply to even primary residences. Number one is the mortgage interest deduction. As a homeowner, you can write off the interest paid to your mortgage. You are also able to write off both the property taxes and the hazard insurance you pay throughout the year. Of course, these three benefits work with investment properties as well, and since the mortgage interest can be such a large percentage of what you pay, this is among one of the reasons investors choose to buy investment properties with a loan versus all cash, as I discuss in my leverage and how to use it properly video. The other fairly common write-off that sometimes go unnoticed are loan points. You're able to write off the points paid to the lender over the length of the loan. Now please note, you can write them off the term length of the loan, not the time it's amortized. If you have a 25 or 35 year amortization loan due in 5 or 10 years, the term length, either 5 or 10 in this example, is how long you can write off those points. Investing in real estate allows you to take a few more deductions that you can't with a primary residence. For instance, you can write off the building's improvement value over 27.5 years or 39 years, depending if it's a residential multifamily or commercial building. You must pay a portion of this back in the form of cost recovery recapture, but I'll discuss that point in a bit. Also for investment properties, by adding the closing costs paid when you buy and deducting the closing costs when you sell, you can adjust your cost basis. Along with all of this, you can deduct any repairs, property management, and even utilities, just to name a few. Now, when it comes to finally selling a property, many times you can defer the taxes or skip paying them altogether. If you sell your primary residence for a profit, up to $250,000 if you're single or $500,000 if you're married is completely tax-free. If you're selling an investment property, there are a few options. You can completely defer both the capital gains and the cost recovery tax by doing a 1031 exchange, which I discuss in detail in my 1031 Tax Deferred Exchange video. Keep in mind that I'm not an accountant, so I must recommend that you always speak to a CPA before randomly deducting items that may not be deductible. Also keep in mind, there of course are other financial techniques that could help you soften the blow of the capital gains tax, such as an installment note or even a deferred sales trust, which I go over in my deferred sales trust video. It's all going to depend on what works best for you as an investor and what your future plans are as an individual. Now that's good to know.